There we go. Welcome. I see a few people jumping in. We'll give YouTube a couple seconds to get caught up to us. But welcome to our first October edition of the AI Circle tonight. Hope everyone's doing all right, especially our friends over in Florida that are dealing with all the weather and hurricanes and stuff right now. So I hope everyone's safe. Hope everyone's ready for a good AI Circle. Let's see. I'm only seeing 5 people. If someone can just comment, make sure that you guys can hear me all right. Um, could just be that it's a bad day to have a stream, I guess, but I'll double check. I'd hate for the 50 or so of you that are normally here to miss out on anything. So we'll give you guys a couple extra seconds. Looks like Randy can hear me. Kelly, I'll just have you join me.
Hello.
Hey, Kelly. It's a really strange start so far. We've got 7 people here. Usually it's about 47 right now. That's all right.
Maybe it's because everybody's from Florida.
That could be. Sure hope not. But all right. Well, Suzanne, awesome. I know she's not in Florida, but anyway. Well, Kelly, it's a bit of a different start than normal, but welcome. And I don't know if you just want to jump right into it. I know we're a little pressed for time today, so we can't really sit around here on our thumbs and sit in our hands and all that stuff, I guess. So let me just knock out our disclosure and then we'll jump right into it. So iFlip Investor Inc. and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure the iFlip Smartfolios you select are suitable for your investment profile before trading in a live brokerage account. With that out of the way, for anyone who's just joining us for the first time, here's a little bit of an agenda. Basically, we're going to spend, I would say, 15 or so minutes. Kelly's going to talk about the market and kind of wherever that wants to take him. There haven't been many trades that we've been making lately. I know Kelly was just telling me before we went live here that he might have something to share on the SPY. I guess I won't spoil anything, or maybe he doesn't want to say it. But maybe the reason a lot of people are here is for the Q&A portion, which we do at the end. Feel free to get your questions in, whether it's related to iFlip, our Smartfolios, how to set up an account, what you're thinking about as it relates to the markets. Anything related to that, we're happy to answer. And it seems like we get a lot of questions right at the end, right before we have to jump off. So I want to make sure everyone has plenty of time to get your questions answered. So feel free to get those in as soon as possible. And lastly, that Q&A portion is it's your way to potentially be our Amazon winner tonight. So we'll give away an Amazon gift card, which is as good as cash for all at least it is to me. So Kelly, with all that out of the way, I'm sure you probably have screen to share. Anything you want to say before? I know we kind of briefly discussed the hurricane and hope everyone's safe and all that, but I wonder if that has any impact on the market.
Good lead-off question. I mean, as we were discussing before, if we were to look at these hurricanes, there's kind of sadly, sort of like after Katrina in 2005, markets like these kind of things, if you can believe it. And the reason is because as there is a catastrophic loss of property, generally government insurance companies have to rebuild it. And alas, corporations have more to sell and people have more to buy. Demand is created after destruction, especially in a thriving economy. So generally speaking, these things are generally good for indices like the S&P or the Dow. So I'm not really surprised that we had a pretty decent rally today in the Dow, because they see the hurricane going to make landfall somewhere around midnight or just after that Eastern time today.
Yeah.
Well, actually tomorrow. So no, nothing more I want to add there. The main thing I think when you see storms like this is there's generally a pop in crude oil prices, but today we had marginally, very kind of flat pricing today, a little bit lower, but most of that is because we remember there's a couple of wars going on, and I mean, when we look at this world and we see the problems in the Taiwan Straits, and we see the problems in the South China Sea, and we see the issues going on in Israel and Ukraine, we don't exactly live in the greatest of times right now. These things cost our country money. We do have $1.8 trillion of debt. It's increasing all the time. Interest rates practically have to go lower to be able to allow the Fed and our government to bail our own selves out from our own spending. So, I mean, it's a very interesting trail that the U.S. is on right now. And I really can't comment beyond that unless you start to go political. But let's just look at the markets, because politics, one way or another, the markets roll on. Politicians change, governments, but our government at least seems to want to go forward, whether it's bad or good. So right now, if we just look at the markets, it seems like everything is good. We see the Dow, of course, made a new high today and closed there, which is a very positive thing for the market, up $400. If we look at the broader indices, the S&P is on its high as well, made a new high. The NASDAQ, however, is still just marginally off its high by just a couple of percent. Might even be just 1.5%. I think it's also worth noting, interestingly, that the VIX, even though the market's making highs, the VIX is actually gone higher, and it sits still in the 20s, even though the market's at all-time highs. That's unusual. Normally, when you see a VIX that is increasing, the market is decreasing.
And so, Kelly, sorry to interrupt you, but for those, because I know what the VIX is, and as do you, but for those who maybe don't, explain what it measures.
It's the volatility index. Through a bunch of calculations, it's essentially measuring what traders in the options market think of the risk, the current risk in the market. And 20 means, essentially, if you have a VIX of 20, it's essentially saying that there's a probability that the market could move 20% one way or another over the next 90 days, because they look at 3-month options. It's complicated. Higher the VIX, the higher the expected volatility.
It's kind of indirectly like a risk type number, I guess.
Exactly, a risk number, the volatility index. I'm sorry, everyone. I do refer to it as if everybody understands that, and good for catching me on that late. Let's quickly go down, and then I'm going to come back to the S&P. Apple is close to its all-time highs, although they're having a lot of trouble with their i15 sales. It's not exactly looking that good. It's again, when the markets are going up, it is lifting all boats, although Apple, to me, feels weak. But you can't see it in the price action. Google, same thing, pretty well off of its highs. Google definitely struggling. It's almost below its 200-day moving average. Generally, stocks below the 200-day moving average are not things you want to own. And it's challenged that, by the way, twice just this year, once in March and once recently in, September, just last month. And so interesting that markets are on their highs and some of these major stocks are not. Here's Meta, of course, on its highs. Amazon just marginally off. Microsoft definitely off, similar to Google. Netflix right there, highs. And NVIDIA, of course, right at close to the old highs. I don't like NVIDIA here, but it doesn't matter. That's where it is. Oil prices, as we looked earlier, we are kind of trending down, but oil prices have come down. They're spiking up here, but mostly from the Israeli operation in northern Beirut, and also for the issues of the hurricane. It's just kind of repricing itself. The general trend for oil is definitely lower. If I was to be a commodities trader, I'd probably short oil somewhere after the hurricane or even now. And we can see that in terms of some of these stock prices. They came off a bit. But keep in mind, they just made new highs here in Exxon. made new highs, and it's just barely off its highs. So the oil markets are loved. Here's our kind of our favorites, as everybody knows, our pipeline stocks that have infrastructure that we all like. And right there, looking to pay a dividend coming up next month. Same thing with Plains All American, close to its highs, maybe, oh, juice, maybe 75 cents, maybe a 2%, 2.5% off its high. Let's switch over to some of the banks. Here's JP Morgan. Banks kind of look good. Why? They just, everything does. I think all stocks are being lifted as the market just absorbs, final, all kinds of dollars that it can find. Seems that everybody's putting them into stocks. The other thing I think we should note is these cruise lines. They have really popped. So if you have SPY Eye, keep that one in mind. Look at Carnival. Carnival here was at 14.18 in the end of August, and it's now, I can read it, $20. So it's actually gone up about 30% in about 2 months. So, well, almost 2 months, yes. And so I think that is kind of really interesting. And here's Norwegian Cruise Lines, another one I look at. And look at that today, up $2. These things are just maneuvering to all-time highs. So these are, again, here's another stock that was also around $15. This one's up $8, so it's up almost 50% in 2 months. So if you own these things, if you're in the SPY Eye, we want to kind of get over to some AT&T. As we know, all these telecoms have done very well. Why? Maybe because they were misunderstood, misthought of, misappropriated, whatever. They seem so boring in a world of NVIDIAs. However, they've been paying that 6.7% dividend for quite some time. Now the dividend's a little bit lower. It's down to like 5.5, 5.4, but it's because they've rallied. If we look back here from April of this year, just 4 months, now we're literally 6 months and a half a year. They've gone from 15 to 21, up 50%. Not as exciting as something like Norwegian Cruise Lines that did that in 2 months. But for a telecom, a company of this size, to be able to rally 50% and pay a dividend along the way is kind of a beautiful thing, can we say? And I'm glad to say that we are in them in most of our portfolios, especially the conservative. We can see another thing. Here's Walmart. Walmart's also at its highs. And of course, this kind of all makes sense. The consumer, whether they have money or not, Americans definitely buy things. And as they buy things, generally they're bought at Walmart. And now that the dock strike is over, at least on the East Coast, hopefully we don't get a new one on the West Coast. And it was ended very quickly through presidential bargaining, whatever that means. Two things are to be sure. One, it's not like we're going to have any supply side disruptions in this case. But two, you can definitely count on prices and wages going higher. We now are experiencing wage price inflation, which is exactly what we experienced in the late 70s, early 80s. And that led obviously to extremely high interest rates and of course a recession. And it changed the complete political landscape at the end of the 1970s. And the country went very conservative to a different kind of government to be able to address those kind of problems. We have them today. And I wonder if this is kind of history repeating itself literally 45 years later. Bitcoin kind of all of nowhere. So again, I always like to talk about the BitFlip portfolio here because, again, we do want to own this. As you can see, this is a huge pennant with nefarious kind of looking lower highs occurring. Look at this. We have lower low, lower low, lower low, and lower high. This high is lower than this high, lower than that high. This one is lower than lower than lower. Same thing here, which means they're coming into what they call a pennant. Generally, pennants depending on which way they break out, there was a continuation of the move. My expectation here is if the stock market can continue to hold on, that it will break out to the upside. But keep in mind, that's my book. That's what I want to happen, not necessarily what will happen. And we must distinguish that. That is what they call an opinion, where I'm allowed to opine. But my recommendation is to say, regardless of that, I like this stock. I want to be long it. It's up to everybody else to say if they want to be in this kind of a place. And if you are, this isn't a big bet thing. This is a percentage of any portfolio, just as gold was many years ago. I will point out two things, though, that are concerning, deeply concerning to me, and we have to see how they bear out. As you know, I always, when I look at the market, I also say, okay, yeah, we're at new highs in the Dow, in the S&P, and very close in the NASDAQ. Here we are in the NASDAQ, sorry. But what's going on with interest rates? Remember, they're inversely related. Let's take a look. They have come really, the price has come way down, which means rates have gone up. Rates have now over 4% again, when they were down to 3.7. So here, interest rates were at 3.7 on the 10-year note. And literally, not even a month later, they're here challenging a 200-day moving average. The market made new highs, even though the bond market sold off and went to higher rates. The stock market is so brazen right now that it says it's just a matter of time. Interest rates are going to go lower. The Fed's going to cut more. That's their bet. The price is not saying that right now, but that's how the stock market thinks. So years ago, we always thought the bond market was smarter. But years ago, there was baby boomers that were essentially building their jobs and their job sets and finding out their futures. And today we have the children of the baby boomers that are taking over the greatest, what they call the great generation that was born after World War II. And they have a completely different mindset. So don't know what to expect anymore. In an earlier time, I would expect this relationship to take its toll on the stock market. But I don't understand the current generation of people, and markets may be markets and fundamentals may be fundamentals. But I wonder if this new generation is understanding what higher rates mean, at least even in a short period of time, to the trade deficit, and by the way, to their just budget deficit, which is now, of course, at its highest level ever. So when I see this action of the bond market going down in price and the stock market going up, that's a divergence. That definitely concerns me for a potential market retreat. And here's another thing I know. I'm going to look at the S&P here. I can tell you that, as you know, the way Flip works is that we use two ways of managing our portfolios. One, we use risk management algorithms. And those risk management algorithms also are the way we decide that we want to be, one way that we decide we want to be in or out of the market. If risk is okay, then we can let machine learning give us a signal to be in the market. If risk is bad according to our rules, AI will only override an existing long position, which means it would only get us out. But I can tell you here, we are within approximately 1% movement higher in the S&P, where we would have a profit take from the purchase we made at the end of July, early August. I think it was the early part of August.
I believe it was the 5th. Sorry,
it looks like it was the 5th. I could tell you it was on this day right here.
Yep, it was that Monday, right after the Friday crash.
Right. We had a Friday crash, and then we had the Monday way down market. We bought the market right where my crosshair is, the horizontal bar, almost at the very low of that bar. In other words, on the open, which is the way we do it, we bought the market. And the market has done one thing. This is one of those rare occasions where we put on a trade, no pain. No pain occurred to anyone on that day. The day we bought it, the market never looked back. It almost looks like genius. It is just math in this case. It was risk management. And I'll explain a little of that here for the people watching today. And since that time, the market has gone up 15% in literally 2 months and what is it now, 9 days. 15.6%. One more percent, I can tell you that we will get a risk management signal on the algorithmic side to be out of the market, which means we would sell our S&P position and take whatever profit we have at that time, which is that the way we look at it now, it would be approximately 16.7% or so in 2 months. And the only reason we would get out is for a risk management reason. And if we do get out, what will happen after that is the way our product works before AI kicks in is we'll have a 5-day cooling off period. And if the market doesn't break, and according to our rules, if it does not break, in other words, it stays pretty steady in the same area or even moves a little higher, we will buy the market back and keep a very tight stop on it. And the only thing that would get us out then would be either machine learning or the tight stop. So we are literally within a percent of a profit take on the S&P, which is our single biggest item in most all of our portfolios. In other words, we have more money allocated to the S&P than any other stock at all. So we might own 25% of the S&P and 75% of just other stocks. The other stocks don't have signals like this, but the S&P does, and that's how we use it. That's the hedge. That's the way a fund manager hedges his bets with when he has his fund management customers. They have a large position in the overall market, which they feel high conviction of, and they have good modeling for. And so they use that to get in and out of the market and put risk on or risk off. In our case here, it'll be risk off if we move a percent higher. Let's hope it happens tomorrow. We do have numbers coming out tomorrow. And when they do, let's see what happens. And if the market could pop and even just touch 1% higher, we would probably get our sell signal tomorrow night or whatever day that occurs, that we would have touched 1% higher than current pricing. So let's see what happens. And with that, I think we can kind of fold and answer some questions.
Perfect. There's haven't been many yet. I just find it fascinating on the SPY. It's, roughly 577 or so now. I remember when it was in the threes. Crazy. Hope that makes sense, everyone. That was all really good stuff. And Kelly's kind of downplaying it, but he said it a little bit. He gave himself a little bit of credit, or the system a little credit, that it doesn't always work like this. That buy on August 5th, and to make 15 or 16% in the matter of a few months is. I hope you guys, everyone who's watching, already has accounts that have been set up and have been able to experience this, because it's been pretty cool. So go ahead.
Look, before if some questions come in, and even if they don't, let me give a little color on this to everybody out there. I can tell you that in June and July, we would field, and I personally fielded many questions from people that were saying, why aren't we in the S&P? Why aren't we in the S&P? The market's going up. I told them the same issue of risk and reward, just what I said right here. And if you think about it, look back here. We had a very similar situation where the market was giving us a reason to be out. In other words, it becomes too rich. And when a market becomes rich, if you put the trade on, you have way more risk than on the downside, that you would possibly have opportunity on the upside. That's not the time to put a trade on. That being said, the market always corrects. It just does. It's just the nature of the ebb and flow, just like waves on an ocean. And when the market finally corrected towards the end of late July, and then fell throughout the month of July, people, all of a sudden, the phone calls and the questions about why aren't we in all dissipated. There was none of them in a chat box, nobody reaching out to me. It went quiet. And then when we bought the market and it rallied, again, nobody's obviously calling. Okay, we're now in the market, and we're in the market a lot cheaper than we would have been if I were to just say, well, I don't know, the market seems rich. We might have bought it. We might have had a couple of percent on the upside, but then we had literally a 10% correction on the downside. So the idea here is that we never know if we're going to be in the market or out. We are timing the market, folks. We are. And we time the market through risk and reward. There are times when the market has less risk, and there are times when the market has more risk. If we're in the market and it has more risk, we have stops to protect us. If we're out of the market and it has risk, we will not get in the market. We will wait for a correction. And by the way, remember, it always corrects. It doesn't matter. It will correct. And so all of a sudden, the questions that we were fielding in July all are gone. And now I wonder what's going to happen, because again, a lot of people have to understand what we do. And I hope that, if the market goes up and we take a profit, everybody will be happy with that profit. But then they're hoping that the market will go back down so we can buy it. Now, I'm one of them, but we'll see what happens. But this is just something of the nature of this kind of approach to managing risk. Otherwise, I could never be able to give a person the statement that saying we're always trying to keep us within 10% of our all-time high in our portfolio. If you want to do that, that means there is some sacrifices. And the sacrifices are oftentimes just having more cash than other portfolios have. But if we have cash doesn't lose when the market goes down. That's how we do it. Yep. And so that is so fundamental. And when I started into this side of the business, and I'll be brief, I didn't realize that I thought everybody understood what I did, but they don't. They just don't.
The minority for sure.
And I'm just hoping everybody that listens on these AI circles understands that this is a sophisticated way to do things. It's organized, and it actually works. It just works. So always bear with us. Always understand there's something happening in the background that makes things happen. And those things are just math. The relationship between price and risk is always being looked at.
Yep. I think this is a perfect question for you to add some color to. It was answered in the chat, but Phyllis asked, basically, when you get in or out of the S&P on, say, the balanced portfolio, how much will you sell? So the short is that if the AI wants us in or if the AI wants us out, we're either fully, say it's just easy math, 10% allocated to the SPY. That whole 10% is either invested or it's in cash. Kelly, add some color as to why.
Right, exactly. So the reason when we put together a portfolio, like I'll give you the balanced portfolio, I think there's 20 items, 20 symbols in the balanced. But the balance will have, right now, I think it's about an 18% allocation to somewhere between 18 and 22% allocation to the S&P. So let's just assume it was 20 for easy math. If we get the signal to get out, that means the other 19 symbols in your portfolio, they don't have that symbol to get out. That means that if we were fully invested in all stocks, and I think we are, we might not have one or two already, then we would have 80% of our money in stocks and 20% in cash. And the 20% in cash would be, of course, because we got out of the S&P.
Yeah.
That means 80% of your portfolio is still working. And the other 20% is cash. If the market goes down, you have only 80% exposure instead of 100% exposure. If it goes down, we hopefully will buy it again. So that's how we do it. It's how much it is it's a binary decision. We get a signal to get out. We get out of all of it, not just some of it, all of that symbol, but doesn't mean anything to do with all the other symbols.
Yep. I was maybe thinking of it differently. I think of someone who maybe trades, who say they have 1,000 shares of a stock and it goes well, and they maybe sell, a couple hundred of them, take a little bit of profit, and they kind of position size themselves. They're not fully in or fully out, which is just a different way of thinking, and honestly, a totally different. We're investing, they're trading. It's totally different. But in my opinion, it's, if the AI is sensing that, hey, this is an opportunistic time for this money to be invested in the SPY, why would you want 20% of it invested in the SPY? Why not the full amount that you have set aside to allocated towards that SPY? Same thing on the reverse.
Yeah, kind of. That's another way. And this question actually bears even a little further discussion. Remember, when the SPY is an index, the other symbols represent individual companies. The SPY is an index of the S&P 500, and it's an ETF. So indices have different behavior than stocks. Indices represent an aggregate. And in that aggregate, what it ends up doing is lowering the volatility of the overall product. So the S&P's volatility, of course, will be less than any individual stock, right? Individual stocks can move 4 or 5% a day, and it's not uncommon. I mean, you look at NVIDIA, for example, and it moves around 3% a day. The S&P 500 generally moves around 0.5% a day. Why? Because it's an index. It's the sum of all the 500 stocks in the S&P. And as a result, believe it or not, when you try to map things, and when I use the word map, I mean apply machine learning, apply algorithmic risk management approaches, you can map an index generally a lot better than you can map a stock. Machine learning is a completely different thing. But if you can map something very accurately on an index, then you should pay attention to that. Because generally, if the S&P goes down, the markets will also, the general individual symbols will go down as well, but in different ways. And that's why I put up another chart real quick, and I'll elaborate one last piece. Here's an example of Norwegian Cruise Lines, up almost 11% today. How often have you ever seen the S&P go up 11% in a day? It won't happen. It would take, something huge to happen. If the S&P were to go down 5% a day, which I've seen a couple of times in my life, and I have seen it move 10% in a day back in 2008, 9. I remember that. It did move that much in a day.
COVID, there were some pretty big ones too.
And COVID a little bit, but not quite like 2009. No. Here's an example of the way you would trade it. Like, personally can tell you that I do trade CCL and Norwegian. And in this area here, I did take half my positions off, expecting a downturn. Yeah, I got it. But then it just zoomed up through my pricing. So now I'm only holding half of what I held before. But I'm willing to do that. But you can't do that on an index. You can't do that same approach. So if I have an expectation as a trader where I'm just using my mind, my skills, charts, whatever I'm using, a good money management approach is to take something off the table when you feel you're at resistance and look for an opportunity to buy it as you fall back into a range. And in this case, if you can see, these are range bound things, right? They're moving in a range. When they move to this range, I would have been a buyer somewhere in the middle of this range. Never got it. Just decided to pop up another 20% after a 10% fallback. So I felt like a genius for about a week. And then the last, 4 days made me look like a fool. But that's okay, because that's trading. And I still have half my position on. S&P, much more resolute. You must do it a different way. And of course, the way we design the algorithmic side of what we do, it is done a different way. Machine learning, again, Totally different. Works
Perfect.
completely different.
Awesome. Well, before I get to this next one, Jennifer, thank you for giving us some comedy in the chat. I found this, and I think David did as well, to be pretty funny. But it's more of a serious question. And I'll give you an answer. But so this is from Jennifer about an email from Optionality about Velox moving to Apex. In short, if you can just reach out to me at lee@iflipinvest.com, I'll put my email in the chat as well. There could be a couple things we might not need anything from you, but I just want to clarify it is a legit email. Velox and Apex are basically clearing firms. We're moving everyone, if you haven't already been moved, from Velox to Apex, and Optionality is the introducing broker. So there may be something to do there, very well could not be, but sorry you're confused by it, but we'll just reach out to me and I'll let you know if there's anything we need to do. And there's my email in the chat if you want to reach out, Jennifer. But I like the name Terry the Beast as well. So that was pretty funny. David did too.
I saw that too. Terry the Beast.
It's awesome.
We'll ask Terry the Beast.
So, all right. Well, I haven't seen any other questions. I'll give you guys another minute or two. If there's nothing else to cover, that's fine. If you do have other questions, we've got, I don't know, maybe 5 or so more minutes until we need to sign off. So feel free to get those last couple questions in the chat and we'd be happy to answer them.
And I'll throw a couple of other things out real quick while I'm looking. Well, if there's any other questions, because we already know the winner of the Amazon card if we don't get any others. One of the things I'm kind of got a watch list on that I think is kind of interesting is when I look at this Bitcoin market, which is always kind of fun to look at. If we go here, this is a representation of Bitcoin through the GBTC. You can see this coiling in what they call a downward sloping pennant. Pennants always are kind of generally downward sloping. Upward sloping ones generally break out to the upside. Downward sloping ones could go either way. But if we can see that the overall trend going back to 2023, at least before the COVID thing occurred and brought the market down, has been to the upside. My expectation, of course, is that this is a product that will go much higher. And so it seems to be coiling to move, to have a breakout of some kind. I want it to be to the upside, but I'm also noticing the volatility is coming in on this. And with markets at new highs, I'm expecting in fall being upon us, because we're here, that generally the market tends to do good going into Christmas. See if that happens again. I think that's worthwhile. Another stock that we had some craziness going on this last week is Merck. It's obviously, we know what the company is. It's a pharmaceutical. It makes drugs. But this is a stock that is not doing as well as some of the other drug companies like Lilly and other, even, well, Pfizer never seems to do well anymore. But this is a stock that seems to have had its day. It is in some of our portfolios, but it is really, really struggling. And this is something that may be kicked out of a portfolio and replaced with something improved within some time before the end of the year. There's other kinds of products that can go into our portfolios. And so this is something that tells our machine learning algorithms that we're not able to find good trades or good positioning here. And it will just kick to say, okay, what's better? Just like the way the S&P 500 works. Things don't work and they lose their market cap or they find disinterest from its consumers, they kick them out. That's the way you make your portfolios go higher. We do pretty much the same thing as them. We only want to have our portfolios consisting of products that have promise and are moving higher. So that's part of the concept, aside from the way we manage them once they're in there. So there's some insight of how it works back here.
Perfect. I think it's kind of a question from Jonathan that talked about the Middle East impact.
Hi,
I wish I had
Jonathan.
more context to this, but
I can add some to that, I guess. I mean, I think that we all see the pundits on TV, and the impact to the market is honestly, this sounds so ridiculous, but the markets actually like war. They like hurricanes. They like things that disrupt because that creates buying. It creates anything that is destroyed generally in a populated world is going to be rebuilt. So what Israel is doing right now, apparently, to me, is doing the same thing in Beirut as it did in Gaza. It is completely destroying the infrastructure. And by destroying the infrastructure, um, the obviously the impact of that is for a safer Israel. Very difficult to use people as human shields if they can't live in a home or go to a hospital. So if it's all blown up, the people can't be there. It's if missiles are fired, they can go in there indiscriminately and drop cheap bombs to stop them instead of expensive ones that target homes. So I think it's an economic question, and the destruction that's occurring obviously affects the price of oil, but it's also going to affect many other companies in the years to come, both European and American companies, to help on the rebuilding of it. And so that's why these kind of malaise around the world is a good thing for, you know, worldwide corporations. The fallout of it is we need new pipes for infrastructure, right? We need new faucet handles. We need new brick. We need new cement. We need more wood. We need more aluminum. So it creates demand. And that's why the impact of the Middle East is not just oil. It's what happens afterwards is a rebuilding, because they will do something to rebuild it. It might take years, but that's what's going to happen. These things are generally good for the markets.
sounds. I was going to say good. But obviously, it's all bad things in the world, but it all makes sense.
Poor
I
choice
don't,
of words on my point, folks.
no, that was
Poor is
me.
never good.
No, but you're just talking about the impact on the market, and if that's the truth. It's the truth. I'm just double checking. I don't think we missed any questions. So a little lighter today. I think we're going to be signing off soon. There's the next AI circle is a bit up in the air. We may still have it on the 23rd, so 2 weeks from today. We may not, but just stay tuned in your emails. I'm sure you guys get our notifications about this. Should be the 23rd, but you never know. It might not be. So we'll communicate to you guys when the next one is. I'm banking on it being the 23rd, but you never know. So, Kelly, any final remarks before we let everyone go?
No, very, believe it or not, even though the market's at new highs, very little has happened since the last 2 weeks. And it's evidenced by kind of if we look back here when I was doing it, you can kind of see the market since the last AI circle has really moved nowhere. And I think if we came back tomorrow and I did the AI circle, the market just might fall back. So even though it's at new highs, it was at new highs 5 other times since the last AI circle, and it keeps falling back. So the market's consolidating. There's really very little going on right now, other than the political situation, which is one of the reasons I think, we have election coming up, and well, my gosh, it's less than 30 days. And when that occurs, that makes sense that the markets kind of go into a consolidation point right before an election, waiting to see where we should go next.
Perfect. And I almost forgot again, but we didn't have as many questions today, but I thought it was a very thought-provoking one. Kelly, I think I know your winner, but I want to make sure you didn't change your mind.
No, it's the same.
Yeah.
It was the very first question and beyond the second question. So who was the person that asked that? They get the prize.
Yeah, so it's Phyllis. Congratulations. I'm not sure if this is your first time on the AI Circle, or maybe you've watched one a couple weeks ago, but I think you're 1 for 1 on being our winner. So that's awesome. You may can only go downhill from here. No, but Phyllis, so all you need to do is just send us an email to mailbag at iflipinvest.com. Either just send us a screenshot of your account or give us your account number, and someone on our team will reach out to you to show you how to redeem your Amazon gift card. So congratulations. I'm going to triple check that we didn't miss anything in the chat. Wow, we're full of the great names today. Beans and rice, that's awesome. Thank you for the episode. Feeling smarter and smarter. I'm getting happier and happier by every name that I read in our chat. So let's keep it going that way.
Yeah, go Terry the Beast.
It's
Or is that maybe Jennifer?
Right. Terry the Beast and Beans and Rice, that you guys could have a nice collaboration, I think. Anyway, well, everyone else, have a great night. Thanks for being on today, and we will see you back in a couple weeks.